of L&T Technology Services Limited. As a reminder, all participant lines will remain in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal the operator by pressing star, then 0 on your touch-tone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sandesh Nayak, Head of Investor Relations. Please go ahead.
Thank you, Ryan. Hello, everyone. I am Sandesh and welcome you all to the earnings call of L&T Technology Services for the fourth quarter of FY25. Our financial results, investor release and press release have been filed on the stock exchanges and are also available on our website www.ltts.com. I hope you have had a chance to go through them. This call is for 60 minutes. We will first start with the management remarks, which would be for about 20 minutes, and then open up for Q&A. The audio recording of this call will be available on our website approximately 1 hour after the call ends. With that, let me introduce you to the leadership team present on this call. We have with us Amit Chadha, CEO and MD, Abhishek Sinha, Executive Director and President, Alan Saxena, Executive Director and President, and Rajiv Gupta, CFO. We will begin with Amit providing an overview of the company performance and outlook, followed by Rajiv, who will walk you through the financial performance. I now invite Amit for his opening remarks.
Perfect. Thank you, Sandesh, and thank you all for joining us on the call on a busy results day today. You'll bear with me with my voice today. I have a little bit of a throat infection, but I'll try and do my best. We hit 3 major milestones during the quarter. Crossed 10,000 crores in annual revenue in rupee terms. With this, the company has an annualized run rate of $1.4 billion. Registered highest ever large deals TCV bookings, higher than Q3 as well, which was a record for us in itself. Surpassed 1,500 patents filing till date. Coming to quarter 4 results and highlights, even in a tough market environment, we had a third straight quarter of sequential organic and overall growth in quarter 4 FY25. Industry-leading revenue growth in USD was up 10.7%, led by tech and sustainability segments. Continuing from Q3, our large deal momentum recorded the highest ever TCV bookings, including one $80 million plus deal, one $50 million plus deal, along with $30 million plus one deal, $20 million plus one deal, and 3 USD $10 million plus deals. Order inflow, as I look at it, on these large deals alone, is up quarter on quarter more than 25%. Half of these deals were won against competition, reflecting our growing market share based on our differentiated offerings, which we had invested in during the first half of the year, AI, Gen AI, and other technologies. We had anticipated better revenue growth in quarter 4. However, during the quarter, the overall macroeconomic environment created unexpected headwinds for us. Few of the large deals we won saw delay in ramp-ups, and signing of some large deals got deferred to the end of the quarter. As you are aware, we announced one deal on the 31st of March as well. Second, in order to support select strategic customers, some of our proprietary software solutions and niche engineering work, which was done, or had to be done on an investment basis. We believe this will help us in strengthening our case for larger deals in the future, building bigger market share, wallet share, as well as growing these accounts further. There are some of these agreements, soft agreements we have based on this. Lastly, the EBIT was 13.2 for the quarter. 3 aspects here. This had the impact of IntelliSwift integration during quarter 4, as we had shared in the previous earnings call, the higher growth in SWC revenue, and finally additional costs on supporting customers and related investments that I just talked about earlier. We continue to focus on levers to manage our operations effectively. Now for the full year FY25. In FY25, we delivered a growth of 8.9% in constant currency. As per analyst reports, India Inc. has been growing at 6%. So we're broadly happy that your company has grown higher than industry. Sustainability grew 5.7%. Mobility grew 9.3%, despite a challenging year, while tech, including IntelliSwift, grew 11.3% in CC terms, USD. Europe led the charge, recording the strongest growth of above 21% for us. All other geos showed positive growth. Large deals. In FY25, we closed a total of 32 deals greater than 10 million. One of them 80 million, 350 million, 530 million, 250 million range, and 10 in the 15 to 25 million range. All in all, fairly satisfied with what we've been able to close. I do expect this deal momentum to continue. Technology. We're proud that we surpassed 1,500 patents filing in FY25 cumulatively, including 573 filed for LTTS and 929 on behalf of our customers. Of these, 190 patents are in the AI and Gen AI domain alone, reflecting our focus on advanced technology. With an average of 50 patents added each quarter, our total filing for FY25 now stands at 206. NVIDIA invited and partnered with LTTS across three areas: rail, medtech, and smart spaces. At NVIDIA GTC, LTTS showcased Track EI, an AI-powered railway inspection track tool using NVIDIA Jetson for real-time defect detection and predictive maintenance. Track EI also won the Etihad Rail Innovation Award this quarter. In medtech, the focus is on diagnostic imaging and surgical equipment. In smart spaces, LTTS leveraged its advanced AI fusion platform to set up an integrated command and control center of Mahakum, which enhancing the experience of over 660 million pilgrims. M&A, we have successfully integrated IntelliSwift, allowing us to build a strong portfolio on hyperscalers to address adjacent markets in service-led verticals like retail, fintech, and healthcare. As I go forward into the following quarters, I will start reporting progress, first of solutions and then of deals in retail, fintech, and healthcare to you as well. Let me provide you segmental performance and outlook now. Mobility segment showed resilience with revenues flat in this quarter to previous, like we had guided you in the last quarter. A year ago, we showcased iDrive, our framework for SDVs. We also launched hyper-personalization and AI for driver experience, all of which resonated with our clients at CES. Such investments are paying off for us, not just auto and TNOH as well. We continue to focus on winning large deals in technology areas like SDV, hybrid, and AI. Recently, we won a notable 50 million euro deal, which we announced on 31st March, with a European OEM on SDV, and expect more such deals in the coming quarters from US and Europe. We believe that overall mobility segment will stay muted in the immediate term and will witness a turnaround towards the end of Q2. Coming to sustainability, sustainability did well with a 2% Q-on-Q growth in revenues. Higher growth was tapered due to an unexpected delay in ramp-up of deals signed, but are now all set to grow in the coming year, including April. Companies are realigning the supply chains with a clear focus on leveraging advanced engineering solutions. This includes initiatives like predictive maintenance, real-time asset performance management, and leveraging sensor-driven analytics and industrial AI, all underpinned by LTTS strengths in plant engineering and industrial products. This, we believe, will help us in growing the sustainability segment faster in FY26 as compared to FY25. In plant engineering, we continue to see strong demand in ONG and CPG, led by CapEx projects, plant modernization, digital twins. Key clients to ramp up with us is a large deal in ONG. We were chosen by a European oilfield supplier as a preferred engineering supplier to support green energy initiatives. We also expanded our engagement with an ONG major for engineering and enterprise asset management. CPG continues to spend, and we've created differentiated solutions in that space. We see strong demand for greenfield and brownfield projects in plant modernization, digitization, and safety. In Feb, we introduced Refinery Next, a solution aimed at transforming traditional refineries into sustainable, intelligent, and highly efficient operations. Refinery Next integrates advanced AI-driven tools for predictive maintenance, intelligent asset management, and demand forecasting, along with energy optimization and net carbon compliance. Moving on to industrial, we are seeing larger deals being inked and a robust pipeline of deals going ahead because of our differentiated offerings in industrial machinery, building technology, electrical power and controls. The focus areas will be energy and automation, semiconductor machinery, data centers, motion and robotics. Nearly half the large deals TCV signed in this quarter are in the industrial product subsegment, which is one of our most profitable subsegments. This quarter, we signed our largest deal in industrial products to date, $80 million plus digital engineering transformation deal with a manufacturer of industrial products and solutions. We mark a decade of engineering excellence with Siemens to drive innovation with the creation of integrated digital twins for products and plants. Overall, for the sustainability segment, we see an increased large deal pipeline and expect the growth momentum to be better than Q4, with both industrial and plant subsegment firing at the same time. Finally, moving on to tech. Tech showed the strongest growth, 28% Q-on-Q in revenues led by Smart World, organic software and platform subsegment. Additionally, there was an upside of integration of IntelliSwift revenues for the quarter. Excluding IntelliSwift, tech still had the highest growth amongst all the segments. The software and platforms did well, with growth in both hyperscalers and key service industry accounts in healthcare, fintech, and retail. We are starting to gain traction with at least about 45 senior level meetings done across the IntelliSwift portfolio in the last quarter alone. The feedback and response has been extremely positive and encouraging. The communication, media, and consumer tech sectors are experiencing significant transformation driven by advancements in AI and immersive technologies. In the medtech subsegment, demand is being driven by Quora, digital manufacturing, and sustenance engineering. Overall, we expect medtech software platforms to do well along with IntelliSwift in the coming year. Now let me discuss the outlook for FY26. The ongoing rejigging of tariff-based supply chain dynamics presents significant opportunities for LTTS to drive growth and deliver enhanced value of its clients. With AI adoption accelerating in the software-defined everything and the digital domains, both are core strengths of LTTS, and some of these rejigged offerings that we have done in H1 and capabilities will serve as a key differentiator in securing large, high-impact deals. With Q3 and Q4 having consecutively seen the highest large deal TCV win so far, we are encouraged by the large deal TCV pipeline that we have built so far. We continue to see market share gain across our top accounts. We have multiple 100 million deals, 50 million deals running in advanced stages of negotiation and hope to take them to conclusion in the coming quarters. I will confirm that quarter one looks to be like a quarter four in terms of deal wins as well at this stage. At the same time, we have to bear in mind the uncertain market environment and tightening demand conditions, which is causing disruption in the shorter term, but will be beneficial for the ER&D industry over the medium to long term. To conclude, we believe our go deeper to scale strategy with our diversified portfolio of three segments, mobility, sustainability, and tech, gives us a balanced approach to the market and not limited to one segment. This gives us the confidence of overall growth even in turbulent times. We expect FY26 to be a better year than FY25. I'm confirming double-digit revenue growth in USD CC terms for FY26. I would also like to reaffirm our medium-term outlook of $2 billion of revenue. With that, let me thank you for all your support, encouragement through the year. I now hand over to Rajiv from here. Thank you.
Thank you, Amit. Greetings to all of you. Let me start by saying that we had many positives in quarter four of FY25 and for the year FY25. Quarter four FY25 saw record highest ever deal wins as mentioned by Amit. FY25 revenue crossed rupees 10,000 crores milestone. Our metrics in terms of DSO and free cash flows for FY25 continue to improve. Finally, acquisition of IntelliSwift and integration during Q4 FY25, which of course is in line with our strategy to build capabilities in software and platforms capability for hyperscalers. With that, I will take you through the financial details of Q4 and for the year FY25. Beginning with Q4 FY25 financials, our revenue for the quarter was 2,982 crores, a growth of 12.4% on sequential basis. Our year-on-year growth for the quarter came in at 17.5%. EBIT margins for Q4 came in at 13.2%. Let me walk you through the EBIT movement in this quarter. First, consolidation of IntelliSwift financials had an impact of roughly 150 basis points on the EBIT margins. We had called this out in our Q3 commentary as well. Macro-related headwinds in the quarter impacted anticipated revenues, leading to impact on EBIT margins, especially in higher margin segments such as sustainability and mobility. We did absorb cost to support select strategic customers during these tough market conditions. We firmly believe this will further strengthen our partnership with the customers. Moving to FY25 financials, our revenue was 10,670 crores, a growth of 10.6% over FY24. We saw balanced growth across our diversified segments. EBIT margin for the year came in at 14.9%. Let me explain the EBIT evolution for FY25. We did make investments during H1 of FY25 to augment our solutions and capabilities for new age technologies and also strengthen leadership across our new segments, mobility, sustainability, and tech. This indeed helped us to win record large deals in H2 FY25. And as Amit mentioned, we continue to see stronger pipeline and lot more $50 million plus deals that we pursue. Second, the acquisition of IntelliSwift had an impact on EBIT margins. Finally, macro-related headwinds in Q4 had an unexpected impact on FY25 margins. Moving to below EBIT, other income for the quarter came in at 33 crores, resulting from consolidation of facilities leading to benefits on ROU. Effective tax rate for Q4 FY25 was 27.4% and for FY25 at 27.4% as well. This is within our expectation of 27.5%. Net income for the quarter stood at 311 crores, which is 10.4% of revenue. For FY25, net income came at 1267 crores, which is at 11.9% of revenue. Moving to balance sheet, let me now highlight some of the key line items. Our Q4 combined DSO, including unbilled, continued to improve and came in at 106 days compared to 112 days in Q3, an improvement of 6 days. Q4 unbilled came in at 18 days, similar levels as Q3. We have improved upon this metric compared to our target range of 110 to 115 days. Talking about cash flows, in FY25, free cash flows came in at 1,379 crores versus 1,251 crores in FY24, an all-time high in absolute terms and a healthy 109% of net income. Our cash and investments improved to 2,976 crores end of FY25 versus 2,883 crores end of FY24. This is after paying for IntelliSwift acquisition. On capital return, the board today recommended a final dividend of 38 rupees per share, taking the total dividend for FY25 to rupees 55 per share, translating to a dividend payout of 46% for FY25. Our return on equity stands at 22% for FY25. Moving to revenue metrics, on a sequential basis, our dollar revenue growth was 10.7% in reported terms, mainly driven by 27.9% sequential growth in tech segment. Talking about segmental margin performance for Q4 FY25, mobility segment margins remained flat in line with revenue growth. Sustainability margins declined majorly due to absorption of cost to support select strategic customers. Tech segment margins have been impacted primarily due to IntelliSwift consolidation, cyclical growth of SWC business, and lower than anticipated revenues due to ongoing headwinds. Moving to operational metrics for the quarter, the offshore mix came in at 55.8% lower compared to Q3 due to IntelliSwift consolidation. We aspire to improve this ratio to 60% levels in the medium term. The fixed price revenue mix was 39.9% in Q4 FY25. Client profile, which is active number of clients, went up by 43 due to IntelliSwift acquisition. The categories of 20 million and 1 million plus accounts have shown an improvement in Q4 FY25. Client contribution to revenue in Q4 FY25 continues to be in similar range as compared to Q3 of FY25. We expect revenue from top customers to improve going forward as our targeted client mining programs come to fruition. Headcount improved sequentially by 793 to 24,258 as of year end. This is mainly on account of consolidation with IntelliSwift. Attrition remained range bound at 14.3% levels. The realized rupee for Q4 was around 86.41 to the dollar, a depreciation of 1.6% versus Q3. Before I conclude, let me provide visibility on margin trajectory going forward. With the ongoing headwinds from tariffs and macro-related uncertainties, we remain cautiously optimistic for the next few quarters, though we are quite bullish in terms of our deal wins. Amit already talked about record deal wins in Q4. Q3 also we saw very healthy deal wins. Q1 also we are expecting to see similar levels of healthy deal wins. We will continue to pivot on revenue growth to gain market share while leveraging on operational efficiency for margin improvement, and reiterate our aspiration of improving EBIT margins to mid 16% levels between Q4 FY27 and Q1 FY28. I thank all of you for your support and your cooperation. With that, I hand over to the moderator for Q&A.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use their handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Yogesh Agarwal from HSBC. Please go ahead.
Hi guys, just a couple of questions. Firstly, few clarifications. Sorry if I missed. So in the quarter, you added $33 million incremental revenues. How much was from IntelliSwift?
What's your second question? We will answer it together.
Okay. The second, Amit, is that it's related to it, the margin impact itself, because looks like the 150 basis point was if the full quarter integration was there. Just clarify on that. The other thing is on the organic growth, for the guidance for next year, double digit, does that include IntelliSwift as well? Because that would mean that 7-8% growth would come from there itself. So that's the question.
Yogesh, this is Rajiv here. Let me take the first question, and I'll take the first two questions, and I'll request Amit to take the question on guidance. So, your question was, the increase, how much of that really is coming from IntelliSwift, right? So we did clarify in our quarter 3 commentary that IntelliSwift is a business, annualized business of $100 million. Of course, we continue to work towards growing that business. So hopefully that answers the question. We are not splitting the revenues between LTTS and IntelliSwift. We report that.
No, so the full quarter came in fourth quarter?
So yes, you are seeing the full quarter include IntelliSwift, barring a few days. Technically, the conclusion of the transaction happened on January 3rd.
January 3rd. Okay.
That played out the full quarter, if you may say. Second, in terms of margin dilution, yes, I did call it out in the quarter 3 commentary as well. We saw roughly about 150 basis point of margin dilution on account of IntelliSwift consolidation. Having said that, we are working actively on the integration plan and expect to see synergies both in terms of revenue and cost play out in the next following quarters.
In terms of growth, yes, we've called out double digit, and this is we do still believe that with the storm coming or the storm ongoing, the world has stopped giving guidance and saying where they will go. And it seems to be misty. But having said that, with the backlog of deals that we have got, in addition to that, the strong deals when we have had in the last 2 quarters, we believe double-digit growth is assured. Now, where will that double-digit fall is something to be seen. It's not 10, it's definitely greater than that. But where will it be? We will talk about it as we progress. And yes, a part of that will come from Intelli, and a part of that will come from others. Thank you.
Right. Sorry, just clarification. So since Rajiv said the full quarter was integrated, were you a bit disappointed with the fourth quarter organic growth? I think you did mention some few deals got pushed down. So is that impacted? Because I think we were expecting a bit better growth in the fourth quarter, organic.
Yeah, like if you would have heard my commentary, paid attention to it, I said clearly that in Q4, there were, I'll quote again, few large deals. One saw delay in ramp-ups and signing of deals were deferred to the end of the quarter. B, in order to support select strategic customers, some of our proprietary solutions and niche work was done on an investment basis rather than on a chargeable basis to the customer in order to create good relationships and get larger access to bigger deals in the future. I hope that answers your question.
Got it. Thanks.
Thank you. The next question comes from the line of Karan Uppal from PhillipCapital India. Please go ahead.
Yeah, thanks for the opportunity and thanks for the guidance, Amit. Just the question is on next quarter. So in FY25, we saw SWC seasonality leading to a weaker Q1, so revenue declined 3%. So are you expecting in FY26 also the quantum to be similar and then the growth to pick up in the rest of the year? That's the first question.
Karan, what's your second question? I'll answer it together.
Second question is to Rajiv. So Rajiv, high-tech margins have come up significantly. You explained that it's because of IntelliSwift integration. So should we assume this to be the base for high-tech vertical margins? And any color in terms of segmental margins, how those will evolve in FY26, that would be helpful.
Sure. So let me take the first one, Karan. It's a very good question. Karan, I can confirm we don't want to give quarter-on-quarter guidance like some peer companies do, but I want to give you indicatively at this stage, sustainability will definitely grow quarter-on-quarter. Software and platforms, and which includes organic plus inorganic from Intelli, will grow quarter-on-quarter. MedTech will grow quarter-on-quarter. Mobility will, I think, will grow as well as it looks right now. The seasonality of Smart World is there, but we are trying to beat it if we can. Let's see as the quarter goes how it comes along. It will not be as bad as it was last year. We are trying to minimize it, but that is where I will stop. The quarter to be played out, a lot of work to be done. Rajiv, you want to answer on margins?
Sure. Karan, as far as the margin, I think first, like I've highlighted, right? And of course, I think you read that. The high-tech margins had the impact of Intelliswift acquisition, roughly about 150 basis points. Second, it also had the cyclical growth of Smart World, right? Now, to answer further to your question in terms of where do I see the baseline in terms of the EBITDA margins for each of the segments, I would request that we kind of wait for about a quarter as things are settling down. We called out a few headwinds, right? One, of course, that there were a few large deals that we anticipated to start the quarter, but it kind of got deferred towards latter part of the quarter. Second, we are continuing to support some of our strategic customers. While we're quoting that as investments, we believe that will strengthen our relationships to have even larger deals from those customers. So allow us a quarter till we continue to clarify and see some of this evolve.
Okay. Thanks for the answers and all the best.
Thank you. Ladies and gentlemen, if you wish to ask a question, please press star and 1. Once again, a reminder. Ladies and gentlemen, if you have a question, please press star and 1. The next question comes from the line of Bhavik Mehta from JP Morgan. Please go ahead.
Thank you. So, couple of questions. Firstly, on all these large deals which we have been winning in 3Q and 4Q, how should we think about the ramp-up of those deals over the next couple of quarters? Because in 4Q, we saw some delays in ramp-ups, but how things have changed if you look at April, and how should we expect the trend going forward from a next couple of quarters perspective? And secondly, on margins, Rajiv, how should we think about the wage hikes this time around? Which quarter will we see the impact of that? Thank you.
Bhavik, as far as deal ramp-ups is concerned, the ones that we won in Q3 have all ramped up now and will provide us revenue in Q1 and beyond. Other than the one that we won on 31st March, the other deals have also started ramping up and should provide us positive revenues in quarter one. The reason I'm confident about sustainability growing faster than quarter four is because I know that is in full flow. Mobility is where we've been seeing challenges. We had expected a little more growth in mobility, but some of these deals got delayed, and I expect that mobility should be either flat or grow, but no more degrowth as far as I can see it right now. So that's the only question. In tech, again, we've been empaneled in a couple of places. 3 of the hyperscalers now are almost 20 million plus accounts for us in an annualized run rate basis. So I believe that growth to carry on because tech is still pumped up about spending on AI and others very relevant to what we are doing. Seasonality of SWC is there, but we are trying to overcome that. So as we go forward, we do believe that we should be able to continue the path that we are on right now.
Bhavik, let me take the wage hike question. So, see, we are cautiously optimistic. I think Amit highlighted a lot of large deal wins. Of course, we'd like to see the ongoing headwinds to settle down in this quarter. As a management, we've yet not made any decision in terms of wage hike. I think that's something that will play out during the quarter, depending on how we see the macro uncertainty kind of settle down.
In fact, we just gave wage hikes in November, Bhavik. So the appraisal process has started, but we haven't made a decision on when to deliver the hikes in CY25.
Okay, thank you.
Thank you. The next question comes from the line of Moez Chandani from Ambit Capital. Please go ahead.
Yeah, hi, good evening, and thank you for taking my questions. I had 3 questions. Firstly, in terms of the large deals that you've signed, Is there any change in terms of pricing or timelines for these deals versus the deals that you were signing, let's say, 2 or 3 quarters ago? That's the first question. Secondly, when it comes to geography, in your conversations with clients, is there any particular geography that you're seeing is worse impacted by these macro headwinds, particularly from North America versus Europe? And just thirdly, and my last question, your on-site mix has seen a sharp increase this quarter. Is this just because of the IntelliSwift acquisition, or has there been any other strategic shift in terms of your on-site offshore revenue mix? Thank you.
As far as large deals is concerned, Mohit, we are seeing probably the same kind of deal making that we saw in the past, just that clients are coming in and asking for better efficiencies, leveraging AI and spot solutions that we've got. So in fact, a significant part of the deal wins we've had this year, quarter and last quarter, have been baking in our own solutions and therefore providing productivity benefits to the customer and keeping some of those as well, right? So that is what we have seen. Now, these unusual requests that came for investments in quarter 4, and in fact came in the last week of the quarter from 2 to 3 of our strategic customers, we have not seen this in the past. We've seen it during COVID as well. So they came in, which we have obliged. But we don't think this is an ongoing thing. Things should, from here on, I think, be okay. Third, in terms of geography you talked about, there is a lot of consolidation deals still running in Europe that we've got. The US has got more new tech, digital transformation kind of deals running. So that's the broad contours. Lastly, we are starting to get a number of inquiries for plant transfer, for line transfer, for operational technology support, for creating servitization of people's product lines, as well as support on the China Plus One strategy, where we are providing them sourcing support as well. So that is a new kind of stuff that we've been seeing coming in as inquiries in the last, shall I say, 6 weeks.
Your question on on-site, this is Rajiv. Let me address to it. Yes, majorly it's on account of IntelliSwift, partly on account of some of the large deals that tend to start where we do work on-site and then we see it moving more towards offshore. But majorly it's on account of IntelliSwift consolidation.
All right, got it. Thank you.
Thank you. The next question comes from the line of Ashish Agarwal from Sundaram AMC. Please go ahead.
Yeah, thanks. I hope I'm audible. Sir, 2 questions from my side. First of all, on the guidance, given the deal signings tailwind we are seeing, both in Q3, Q4, and as you said in Q1, assuming there is no major macro headwind now from here on, apart from what we have seen, is it fair to assume that organically FY26 will be, if not better, similar to FY25? That's my first question. And secondly, on the comment you have made about the investments and you have made and some of the software proprietary solutions, etc., right, which have been provided to the clients. At a later stage, are these reimbursements of the clients, or these are the investments you have already made and this will not be reimbursed from the clients? Yeah, thanks.
So number one, I would like to confirm to you that I do believe organically FY26 will be a better year than FY25. Okay?
Yeah.
If the other shoe doesn't fall tomorrow.
Okay.
Look, I'm being honest, right?
Yeah. Fair enough.
Right. And that's how we are preparing. That's how we are adding. We are adding 2,500 freshers. The first lot of 500 will join in June towards the end. So we are on it, right? So nothing changes for us. I mean, we are preparing for a growth year. Now your second question was, I'm sorry, can you repeat your second question?
The investment.
The investments you have
Got
the proprietary reimbursement.
So look, the way it is it's in one particular case, it was investments that we had made and we had implemented the product for them, the widget for them, and there was a certain money owed to us, and they came back and said that rather than paying you, can you say that this is goodwill generated for us? We're using it across our entire product family, and at some point we will make you whole, and we need support. In a second case, there was a niche solution that we had developed and worked on, which again was going to be billed on 31st March. We were requested to not invoice and again take it as part of our investment for the relationship. So we have agreed to both of these and taken it forward. So we don't see this ongoing, but this was a one-off that we had to accept. We believe this will help us in greater market share. You know, it is in times of these when you support a client that they remember it and then they come back and support you when you need it. I do believe that this will help us in growing our accounts, in growing our relationships, and getting larger deals.
Got it, sir. Thanks a lot.
Thank you. Ladies and gentlemen, a reminder, if you wish to ask a question, please press star and 1. Once again, if you wish to ask a question, please press star and 1. We do have a follow-up question from Bhavik Mehta from JP Morgan. Please go ahead.
Thank you. So going back to this investments related to clients, is it fair to assume that the revenues to an extent should also come back because you were requested not to bill them last quarter? So could that be a tailwind in 1Q or 2Q?
Yes, Bhavik. May not be on the same deal, but other places, yes. Yes.
Okay. And just again, going back to the guidance, is it because you said it's double digit, it's not 10%, it'll be more than 10%. Is it fair to assume that 10% is like the worst case you're working with right now?
Bhavik, again, I request you, you've known us for a long time. Let us say 10%, and I'm saying it's not, I'm saying double digit, I'm saying better than FY25, 26 will be better. And that's where it is. And I don't think it's 10%. So let me leave it there. Of course, that will be better.
Okay, fair enough. Thank you.
Thank you. Ladies and gentlemen, if you wish to ask a question, please press star and 1. A reminder, if you wish to ask a question, please press star and 1. There is a follow-up question from the line of Karan Uppal from Phillip Capital India. Please go ahead.
Yeah, thanks for the opportunity again. So I just wanted to double-click on mobility vertical. So in this vertical, we have seen one large deal of $50 million in SDV space, and you also mentioned that there are further deals in SDV which you are seeing in the pipeline. So fair to assume that within mobility, auto is doing well, but you are seeing pain in aero and off-highway?
Oh, that's not true, Karan. In fact, we are seeing across, there are stops in certain places, but overall we do believe that we've got this differentiated set. My colleague Alin can add.
So I'm sure, Karan, you are looking at the markets, you are aware of how our customers are doing there, whether they are in the automotive or in trucks and off-highway, or in aero. So the pain is there. What we do believe is that this is going to last for about a quarter or so, like we said earlier. But given the solutions and some of the deep relationships that we have and the deals that we have won, part of which we talked about are consolidation deals, some are carve-out deals which are there. We do believe that the growth will come back sooner rather than later in this sector, but still to be washed out. And barring anything else happening, we do remain very bullish about this segment and will continue to perform as we go along.
Okay, thanks a lot.
Thank you. Ladies and gentlemen, if you have a question, please press star and one. The next question comes from the line of Sulabh Govila from Morgan Stanley. Please go ahead.
Yeah, hi. Thanks for taking my question. Firstly, I wanted to check, I'm not sure if you've quantified what's the sort of impact on revenue this quarter from the investment that you did at the end of the quarter, in terms of in the couple of clients that you mentioned?
Sulabh, this is Rajiv. Let me take that one. So we will not break it down, Sulabh. We've of course clarified, that look, we did see an upside from the Analysts acquisition. We've seen a few headwinds. We will not break it down to that level, but what I will suggest is if you can have an offline conversation with Sandesh.
Sure. Understood. And is it fair to assume, similarly on margins, it's fair to assume that when the revenue comes back, the margin also comes back, given that it was just the lack of this revenue that led to the margin weakness?
Prima facie, yes, Sulabh, that's how it is. And, aside of this, we are also running a very targeted margin improvement plan now in the organization. We are conscious that, of course, we didn't see these levels of headwinds, right? They all came in beginning of February. So we are running a lot of, efforts to sustain margins going forward, sustain and improve as well.
Okay, understood. And then I wanted to just double click on a comment that Alin just made, that we see growth coming back in mobility sooner than later. I just wanted to understand what sort of data points or what sort of conversations you're having with clients that are making you believe that could be the case.
So, like I said earlier, we have talked about some of the deals that we have already won earlier in the quarter, and then we have some more transformation deals which are running, which we hope to close sooner rather than later. And that's the confidence that we have based on our relationship with our customers that they will go through, and that will lead to the growth that we are talking about.
Okay. No, my question was more from a perspective of the pause or the stops that are there in certain places, that those getting lifted, if there is a conversation regarding that with the clients.
Yeah. So that's a broader market question. What we are seeing is, and again, this is available in public forums, you can find out that some of the programs that our customers are running, they are getting delayed, so they're getting pushed out by about a year or so. And hence the trajectory of the efforts required to bring them to fruition automatically goes down. So that we will see, and plus the ambiguity that remains because of tariffs and the cost that the customers will have to take as they go through. So those ambiguities do remain, but they also lead to opportunity of consolidation. They lead to opportunity of picking up some of these transformation deals that we are talking about, and that's what we are riding upon. We do see that this will remain, the market as such will remain ambiguous for about another quarter or so. Probably towards the end of second quarter of our financial year, we believe that this will start settling down.
Understood. And then just the last bit from me, Amit, we sort of mentioned on order inflow that half of the order inflow that we got this quarter were won against competition. So assuming this half of these are consolidation deals, is it fair to assume that these come in at a lower margin than the company average?
No, in fact, when I said won against competition, I said 70% of the deals were won in a competitive manner based on solutions we had, right? 30% were single source to us. That's what I meant by that. I would like to confirm to you that all the deals we have won in quarter 4, as well as the deals we have won in quarter 3, are at standard segmental margins in which they have been won.
Perfect. So thanks a lot for taking my questions.
Thank you. Ladies and gentlemen, we have reached the end of the question and answer session. I now hand the conference over to Mr. Sandesh Nayak for his closing comments.
Thank you. Thank you all for joining us on the call today. We hope we were able to answer your queries. If there are any follow-ups, we'll be happy to address them. With that, we are signing off for today and look forward to interacting with you through the quarter. And I wish all of you a very good evening and a good day. Thank you.
Thank you. On behalf of L&T Technology Services Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.